Alright, in this video we're going to be going over the income statement, which shows a company's financial performance over a period of time. In its most concise format, the income statement shows a company's revenues, which can be defined as money or payments a company receives for goods or services sold, less expenses, the cost of providing those goods or services, to arrive at net income. In this way, the income statement provides a measure of profitability of the firm over a specified time period. It can also be thought of as the measure of a company's success in selling a good or service. I wanted to revisit the expanded accounting equation because if you recall that the balance sheet is just a formal presentation of this equation, assets equal to liabilities plus stockholders' equity, then it may also be helpful in understanding how financial statements relate to one another to know that the income statement is represented by the items within this green triangle. Here you have revenue less expenses equivalent to net income. So going back to our simplified income statement, it's worthwhile to spend some time elaborating upon the various expenses you will find on a more thorough income statement. Here we have expanded expenses to show cost of goods sold, operating expenses or SG&A, interest expense, and income tax expense. Starting with cost of goods sold, you have all costs directly associated with providing the good or service sold to the customer. Operating expenses, or SG&A, are all major non-production expenses incurred in running the company. Interest expense relates to the cost of borrowing money. It is the price that a lender or bank charges a borrower, in this case the company. And finally, you have tax expense, the last expense listed on the income statement. All profitable corporations are required to calculate taxes owed to federal and state governments. Having briefly defined expenses, I wanted to move on to operating income and net income. Operating income, or EBIT, an acronym for earnings before interest and taxes, is calculated by subtracting expenses related to the core operation of the business. And net income is calculated by subtracting additional expenses unrelated to the core operation of the business. It's important to distinguish between the two because operating income, or EBIT, is a better measure of a company's ability to operate efficiently. And while you won't see it on most income statements, in most financial models you will find a reference to EBITDA. EBITDA is an acronym that stands for earnings before interest, taxes, depreciation, and amortization. And the reason you will find it in most financial models is because it is frequently used in determining the value of a company. With that, I want to return to the objective of the income statement to introduce a couple accounting concepts. So to echo what was said at the beginning of the video, the objective of the income statement is to demonstrate how successful a company is at selling a good or service. The first accounting principle used to better demonstrate this is the matching principle. This is the process of matching revenue generated by the sale of a good or service with the expense of providing that good or service in the same accounting period. Reworded slightly, the matching principle requires that the costs incurred in generating revenues be recognized in the same period. And it should be emphasized that this is regardless of when cash is paid. To make this point a little clearer, let's look at an income statement on a cash basis, which is to say that revenue and expenses are recorded when cash is received or paid out. We're going to stick with the boat company example from the previous video and say that revenue is earned by selling boats, and that your expenses, or cost of goods sold, are labor or raw materials. If you make the boat in period 1 and spend $2 million on labor and $3 million on materials, for total cost of goods sold of $5 million, in that period you'll show a gross profit of negative $5 million. And then let's say that the sales cycle is very slow and you don't actually sell the boat until period 3. With the price of $10 million, in period 3 you'd show a gross profit of $10 million. Here, your period 1 income statement and your period 3 income statement clearly would not be very helpful in understanding your profitability. If, however, you were to look at this on an accrual basis of accounting, which uses the matching principle, then the revenue generated by the sale of the boat would be matched with the expenses of having manufactured the boat. And in this way, your income statement for period 3 would be a lot more meaningful. And recall that in this example, the cash payments are still made in period 1. But on an accrual basis of accounting, the matching principle requires that you record those expenses in period 3 on the income statement. Going back to the income statement objective, the second accounting concept is depreciation. And for the time being, we'll define depreciation as the allocation of the cost of tangible assets, which you can think of as property, plant, or equipment, over multiple accounting periods representing the useful life of the tangible asset. To better illustrate this point, let's go back to our previous example. Here again, we're looking at our income statement through gross profit on an accrual basis of accounting, which, as you recall, requires we match expenses with revenue. And to this example, let's add a large tangible asset, such as a crane. And here we will assume that a crane costs $5 million and that we acquired the crane in period 1. As before, we will match this expense to the period in which revenue is recognized, which now provides for total cost of goods sold of $10 million, and in period 3 would provide a gross profit of $0. This is not, however, entirely accurate. Clearly, a crane can be used for multiple periods, whereas labor and materials will be used to make that boat in period 3. Let's say that the periods in our example are years, and that the crane has a useful life of 5 years. We can then depreciate the cost of the crane over the 5-year period by allocating the cost to multiple years over the useful life of the asset. This brings your total cost of goods sold to $6 million and provides for a $4 million gross profit. If you then include the sale of a boat in each period, you can see how depreciation more appropriately allocates the cost of the crane as it's being used in each of the 5 periods. And hopefully that provides a better idea of how the matching principle and depreciation allow you to more consistently measure a firm's profitability or success in selling a good or service. Because we just spent a fair amount of time talking about the matching principle, which requires that expenses be matched with associated revenue, it's important to understand when a company can actually recognize revenue. To record revenue, 4 conditions must be met. The first is that delivery has occurred or services have been rendered. There must also be persuasive evidence of an arrangement for customer payment, and this can be cash or a promise to pay cash at a future date. The third condition is that the price must be fixed or determinable. And finally, collection must be reasonably assured. Moving on, I want to talk about a very important relationship between the cash flow statement and the income statement. For every accounting period, the cash flow statement starts with net income. And here it's very important to distinguish between net income and cash, because net income is derived from accounting rules and accruals and does not equate to the actual cash earnings realized in the accounting period. This is a very important relationship to keep in mind as you build financial models. And the link between the income statement and cash flow statement can be demonstrated here on this fully integrated financial statement model, which shows that net income is the first item listed on your cash flow statement and links directly to the income statement above. This relationship provides a great segue to our next video, which will focus on the cash flow statement. But before we conclude the video, I want to quickly summarize the difference between an accrual basis of accounting and a cash basis of accounting. Under an accrual basis of accounting, revenue is recognized when earned, which is to say when the 4 conditions highlighted previously are met. And expenses are recognized when incurred, using the matching principle. Under a cash basis of accounting, revenue is recorded when cash is received, and expenses are recorded when cash is paid. And with these definitions in mind, we can move on to the cash flow statement.